Above all, we need to limit the claim on the taxpayer. I think I've made that point already. Therefore, I think what we need to consider in terms of regulatory strategy, do we try to get to Basel N, the perfect regulatory regime for Objective 1, or should we develop yet further Pillar 4 of the Basel Accord? Now, before all of you look up your newspapers and past papers to say, I'm sorry, I didn't realise there was a Pillar 4, you're absolutely right, and that is the problem. We don't have a Pillar 4. And my argument is we do need a Pillar 4. And the Pillar 4 would be an international coordination and harmonisation of resolution arrangements to reduce Objective 2 problems. And my argument is that inconsistencies as between countries in resolution arrangements can be as competitively distorting as different regulations in Pillar 1. Above all, we need a EU-wide resolution arrangements. What I find very disappointing, and I know Graham is going to talk about this, so he may have a different view, the European Commission has proposed a banking union. What we've been clear about, I think, is it's not a banking union. It's a partial union, because there is very little, if anything, in that document that talks about EU-wide resolution arrangements. But a banking union that doesn't have a common set of resolution arrangements is not a banking union. It's a partial banking union, perhaps. It may be a step on the way, but it certainly isn't a true banking union. And equally, when you look at the Commission's proposals on resolution, it's done on an entirely national basis, which again, in my view, just won't solve these problems. Well, of course, the argument could go, this is just a first step. Okay, well, I think what both speakers earlier on today are saying, if anything, we're tending to back off from those arrangements. Very quickly, forget a moral hazard, the simplification of objectives. Objective 1. My view is that it has become just far too complex. We're mistaking precision for accuracy. And if you have a set of risk weights, etc., that are not accurate in the sense that they truly reflect actuarial risk, you are likely to be worse off imposing detailed risk weights compared with having a much more simplified system of basically being dominated by a gearing ratio. The problems with complex risk weights is that you can arbitrage. You can game the system. I would invite you to look at the Bank of England's latest financial stability report. One of the problems they identified there is these risk weights are not universally applied by the same bank, by different banks. So you have the same asset structure between Bank A and Bank B, but they have different risk weights attached to the same assets. Well, that can't be right. Therefore, my view is, I think we need to think very seriously, and here I will be sacked from all of my jobs as the EBA. Why not scrap risk weights altogether? Do they actually do any good? I wasn't sure whether that was telling me to speed up.
No, I agree.
Why not just scrap the whole lot and have a simple gearing ratio? E over A, E equity capital A is bank assets. And incidentally, I would put that at a quite higher level than the regulators are currently do. So I have very severe doubts about Objective 1. Finally, I would say that, in my view, and I think Patrick was saying this as well, the problem of the crisis was not a fault of regulation. You gather I'm a little bit sceptical about how far regulation can go in Objective 1. It was really a problem of supervision, that the banks weren't supervised correctly. The supervisors were captured, you know, the old theory of regulatory capture. They weren't captured by the banks. They were actually captured, as everybody else was, by the ideology of the time. The ideology that markets work best. Efficient markets, rational expectation, all of those things that we've all learnt in our textbooks, and some of us have written in our textbooks. So I think the real problem we need to address is not regulation, but supervision. Thank you.